Okay, so picture this. It's January 4th, 2026. The holidays are over, and everyone in the financial world is asking the exact same thing. Has the global economy finally found its new normal, or is the ground still shifting under our feet? Well, that's the big question, and that's what we're here to figure out.
Because right now, there are two totally different stories being told about where we're headed. In one corner, you've got the optimists talking about a massive AI supercycle that could push the S&P to, 8,000. But in the other corner, you have the pessimists warning about inflation that just won't go away and a global economy that's slowing down. This, my friends, is what they're calling the Great Divergence.
So how is it possible that both of these things could be true? In this explainer, we're going to break down the latest forecasts from some of the heavy hitters. We're talking the IMF, Goldman Sachs, and the Federal Reserve, to really get to the bottom of why the smartest people in the room are seeing such different futures.
All right, let's start with the big picture, the view from 30,000 feet, from the IMF. They're forecasting global growth for 2026 at 3.1%. Now, to be clear, that's not a disaster. It's not a crisis. But it does tell us that the world economy seems to be settling into a lower gear, maybe losing a little bit of that energy it had before the pandemic.
But here's where it gets really interesting. When you look inside that number, you see a split. Advanced economies overall are kind of sluggish, but the US, it's projected to grow at 2.1%. I mean, that's almost double what's expected for the Eurozone. For now, it seems like America is the one clear engine holding up the rest of the global economy.
So that begs a question, right? What is going on in the US? What's fueling this American exceptionalism? Let's dive in and unpack the key drivers that are really setting the US economy apart.
And if you think the IMF's number is pretty good, well, some folks on Wall Street are even more optimistic. Check this out. Goldman Sachs is calling for a really robust 2.6% growth in the US. So what are they seeing that makes them so bullish?
While a huge piece of the puzzle is policy. Specifically, analysts are pointing their fingers right at something called the One Big Beautiful Bill Act, or OBBBA for short. This thing was a massive legislative package that did a couple of key things. It extended important tax cuts, and it pumped a ton of government money into the economy. All of that together created this powerful cushion that's helping shield the economy from some of the headwinds we saw last year.
But government spending is only one side of the coin. Maybe the biggest wild card for 2026, the biggest source of uncertainty, is what's happening over at the Federal Reserve.
And this timeline really lays it all out. A new nominee for Fed chair is expected basically now, because Jerome Powell's term is officially up on May 15th. And believe me, a leadership change at the most powerful central bank in the world, that sends ripples through everything.
Now, whoever takes over is walking into a really tricky situation. You see, inflation has been sticky. It just won't let go. It's hanging around 2.4%, which is still stubbornly above the Fed's 2% target. And since the Fed's #1 job is to keep inflation in check, they have to be super cautious about cutting interest rates. That's why some people think we might only see one single rate cut this entire year.
And this whole situation creates this fascinating thing the market calls the shadow chair effect. Get this, even though we don't know who the next chair will be, traders are already placing bets. They're gambling on who it might be and what their policies might look like. So all of this political uncertainty is translating directly into market volatility right now.
Okay, let's switch gears. We've talked about the risks, but now let's talk about the biggest potential positive, the explosive force that could just steamroll everything else, the massive, massive bet on an AI supercycle.
The buzzword for 2026 is a term Goldman Sachs is using, the physicalization of AI. What does that mean? It means AI is no longer just software, just code on a screen. It's becoming real. It's driving this historic boom in spending on actual physical stuff, building massive new data centers, upgrading our power grids to handle the load, all of it. And the numbers that are coming out of this are, well, they're staggering. JP Morgan has floated a high-end target for the S&P 500 of 8,000. No, that's not a typo. 8,000. That's how big of an impact they think this AI-fueled investment cycle is going to have on company profits.
But here's a wild twist. It's not just about stocks. That same optimistic outlook is also pointing to gold. JP Morgan thinks gold could soar to $5,000 an ounce by the end of the year. Why? Well, it's a mix of central banks around the world buying it up like crazy, and investors who want something that performs well but can also act as a safety net if that AI boom ends up creating some unexpected inflation.
And this is the really crucial part. As JP Morgan's analysis points out, this isn't just a few tech companies getting rich. This spending boom is spreading everywhere. It's hitting utilities, logistics, even healthcare,
It's turning into a truly foundational shift across the whole economy. Okay, that's the super optimistic case. But remember, this is the great divergence. So now we have to flip the coin and look at the other side. All the serious headwinds that could stop this train in its tracks.
And this chart right here shows one of the biggest red flags. Look at that disconnect. The global economy is growing at over 3%, but global trade is barely growing at all, just 0.5%. That's a huge gap, and it's a classic sign of trade tensions and tariffs, which basically act like a giant brake on the world's economy.
And then there's this ghost from the past that might be coming back, the bond vigilantes. With government spending so much money on things like the OBBBA, some big investors are getting nervous. If they get nervous enough, they could start selling off government bonds, which would force interest rates to go up for everybody, even if the Fed wants to cut them. It's basically the market fighting the Fed.
And of course, we have to talk about the huge structural shift happening in China. The IMF sees their growth slowing down to 4.2%. For decades, China was the explosive engine for global growth, but with their property crisis and other issues, that's just not the case anymore.
So, there you have it. Two powerful, completely opposite stories. On one side, this AI-powered boom. On the other, some really serious global risks. So what does this great divergence actually mean for us as we try to navigate the year ahead?
Well, the consensus view seems to be sturdy but uneven. What that means is we're leaving the kind of economy where a rising tide lifts all boats. Those days might be over. This is not an environment where you can just buy anything and watch it go up. 2026 looks like it's going to be a market where you have to be selective. Picking the right winners and losers is going to be absolutely crucial.
So, to wrap it all up, here are the three biggest things you need to watch this year. Number 1, the Fed's leadership transition. Who gets the job is a huge deal. Number 2, the AI infrastructure build-out. Is that spending boom for real? And finally, number 3, the bond market's reaction. Are those bond vigilantes going to show up and spoil the party?
Which leaves us right back where we started, with the ultimate question for 2026. Are we looking at a sturdy, if a little bumpy, transition into a whole new kind of economy? Or is all of this just the calm before the storm? The answer to that is going to define everything.